Ladies and gentlemen, AG here. Before you scroll away, listen carefully. This video is not about silver going up or down. It's not about price targets. It's not about hype. It's about something far more important. A moment when two prices for the same metal exist at the same time, one on paper and one in the real world. By the end of this video, you'll understand exactly why COMEX is losing control, why physical markets are taking the lead, and why silver may be closer to a breaking point than most people realize. Stay with me, because this story only makes sense when you see the full picture. They said it would never happen. They said the system was strong. They said the big ones don't fall, and then it happened. A major bank was quietly liquidated. Not with sirens, not with emergency press conferences, but through margin calls, forced closures, and positions that could no longer be defended. While most people were staring at headlines in fear, a much smaller group leaned forward in their chair. Because moments like this don't destroy the future. They reveal it. I want you to imagine something. You wake up one morning and the rules have shifted. The assumptions you built your financial life around no longer apply. The safety you thought was permanent suddenly feels conditional. What you do in that moment determines everything. Whether you stay stuck in survival mode, or whether you step into the next level of your life. That's exactly where we are right now. History is very clear about one thing. The moments that feel like endings are almost always transitions. When Ray Dalio watched markets collapse, he didn't panic. He studied the structure beneath the noise. When Warren Buffett saw fear in the streets, he didn't run. He went shopping. When Elon Musk nearly lost everything in 2008, he didn't retreat. He doubled down on belief, execution, and long-term conviction. History doesn't remember panic. It remembers positioning. Every financial collapse acts like a mirror. It shows how prepared you are, how disciplined your thinking is, how strong your emotional control really is. Most people respond with fear, not because they're unintelligent, but because they never built the internal structure required to handle uncertainty. But the people who rise, the investors, builders, and wealth creators, they treat volatility like gravity. They understand it's always there. And instead of fighting it, they learn how to use it to move faster. Here's the first shift most people never make. Stop seeing money as a number. Start seeing it as energy. Energy flows where attention goes. If all your attention is on fear, your decisions drain you. If your attention is on structure, positioning, and resilience, your decisions begin to compound. This is why headlines are dangerous. They compress time. They force short-term thinking. They magnify risk and hide opportunity. And this is how wealth quietly transfers hands. Because while the crowd freezes, someone else is studying balance sheets. While the crowd panics, someone else is analyzing supply chains. While the crowd waits for certainty, someone else is positioning for multiple outcomes. Here's the uncomfortable truth. Wealth is not created in comfort. It is created in discomfort with direction. And this is where silver enters the story. Because when systems tremble, when currencies wobble, when trust thins, history shows the same pattern every single time. People return to real value. Not because it's trendy, because it's timeless. To understand why this moment matters, why silver feels different now, you have to understand where power actually lives in commodity markets. It does not live where the most contracts are traded. It does not live where the benchmark price is published. And it does not live on financial television. Power lives in the bottlenecks. And in the silver market, the bottleneck is not mining. This is where most people get it wrong. China does not dominate silver because it digs the most metal out of the ground. In fact, China is only the second largest silver miner in the world. China dominates silver because it controls something far more important: refining and processing. Raw silver coming out of a mine is useless to modern industry. It has to be refined to extremely high purity. It has to meet strict industrial specifications. It has to be processed at massive scale. Solar panels, electric vehicles, semiconductors, power grids, data centers. None of these industries run on paper promises. They run on delivered metal. And while the West spent decades financializing silver, futures, leverage, derivatives, cash settlement, China quietly built the physical infrastructure. Silver mined in Latin America, Africa, even parts of Asia, often passes through Chinese refineries before it ever reaches the global market. That makes China the gatekeeper. And gatekeepers don't need to announce power loudly. They only need to adjust flow. That adjustment is happening right now. Starting January 1st, China's new silver export controls take effect. Notice how quiet this was. No dramatic ban, no emergency press conference, no screaming headlines, just a licensing system. Only refiners producing more than 80 tons per year can export freely. Smaller refiners are effectively locked out. This doesn't stop supply. It redirects it. Silver that would have flowed west now stays east. Domestic Chinese industry gets priority. Exports become selective. Availability tightens quietly. And when supply tightens quietly, price reacts loudly. That's why Shanghai moved first. Shanghai doesn't trade silver as a financial abstraction. It clears physical delivery. Industrial buyers there don't care what COMEX prints on a screen. They care about one thing. Does the metal show up at the factory gate? COMEX doesn't work that way. COMEX is built on leverage, on rolling contracts, on cash settlement. More than 95% of COMEX silver contracts never result in physical delivery. That system works as long as people accept paper instead of metal. But the moment physical demand tightens, paper loses authority. That's what the $85 Shanghai price is telling you. This is not manipulation in the cartoon sense. It's not evil bankers pushing buttons. It's structure. And structure always wins. Because when real buyers show up, buyers who must take delivery, paper prices don't lead. They follow. Late, reluctantly, and often violently. $85 in Shanghai is not a prediction. It's not excitement. It's not a top. It's the price that clears real demand. 79 on COMEX is the price of belief. Belief that delivery can be managed. Belief that inventories are usable. Belief that paper claims will always be honored. Those beliefs are now being tested. And here's the part most people underestimate. When paper markets lose control, they don't lose it gradually. They lose it through forced behavior. Margin calls, delivery requests, inventory stress, sudden repricing. That's why this gap matters. Not because it's $6, but because it tells you who is in control now. When people hear the phrase, paper market is breaking, they often imagine prices crashing. That's not how paper markets fail. A paper market doesn't break when prices go down. It breaks when delivery stops matching promises. And that is exactly what is happening in silver right now. COMEX is not a warehouse. It is not designed to supply industry. It is a clearing system, a financial layer built to manage risk between traders. That distinction matters more now than at any point in modern history. Because on COMEX, over 95% of silver contracts are never settled with metal. They are rolled forward, netted out, closed in cash. For years, this worked. Why? Because nobody pressed the delivery button. As long as participants accepted paper instead of physical silver, the system could carry enormous leverage without consequence. But leverage only works when confidence holds. And confidence is thinning. Here's the number you need to understand. For every 1 ounce of registered physical silver available for delivery, there are hundreds of paper claims attached to it. Different estimates exist. Some say 100 to 1. Others say 200 to 1. Some even higher. But the exact number doesn't matter. What matters is this. The system cannot survive mass delivery requests. It was never designed to. For years, this imbalance didn't matter because physical supply was loose. Vaults were full. Demand was manageable. Industrial buyers weren't panicking. That has changed. Shanghai is pulling metal east. China's export controls are redirecting flow. Industrial demand from solar, EVs, and data centers is accelerating. And now, something critical is happening. More players are asking for metal. When that happens, COMEX faces a brutal math problem. If delivery requests rise, banks have only 2 options. Option 1, deliver metal they don't really have. Option 2, buy metal at whatever price is required. Both options are dangerous because buying pushes price higher. Higher prices trigger margin calls. Margin calls force more buying. That's how control slips away. Not through conspiracy, not through headlines, through forced behavior. This is why $79 on COMEX is fragile. It's not supported by metal. It's supported by belief. Belief that shorts can roll positions. Belief that cash settlement will be accepted. Belief that delivery requests will remain manageable. Shanghai doesn't operate on belief. It operates on availability. If metal is scarce, price moves immediately. That's why Shanghai hit 85. Not because traders were excited, but because buyers needed silver now. This is where the paper price starts to break. Not with a crash, not with an announcement, but with a gap that refuses to close. In a normal market, arbitrage would fix this. Buy silver at $79 in New York. Ship it to Shanghai, sell at $85. Free money. That trade should be automatic. But it isn't happening. Why? Because arbitrage only works when metal can move. If metal cannot move, or doesn't exist where it's priced, arbitrage becomes risk, not profit. That's when markets stop behaving normally. Paper prices keep printing. Physical prices keep rising. 2 prices. 1 asset. That is the definition of a broken market. And here's the most important part. COMEX does not need to collapse for this to matter. It only needs to lose authority. Once the world stops looking at COMEX as the place where silver is priced and starts looking at physical exchanges instead, the adjustment becomes unavoidable. Paper does not argue with reality. It follows it. Late, violently, and reluctantly. If this silver move had happened in March, during full liquidity, with desks fully staffed and risk managers alert, it would have looked very different. But timing matters more than price. And right now, we are sitting inside the most fragile window of the entire financial calendar. Wall Street has a name for it. Ghost Week. The stretch between Christmas and New Year's, this is when senior traders disappear. Risk managers go offline. Liquidity providers pull back. Large desks flatten exposure. What's left behind are skeleton crews and algorithms. And here's the mistake most people make. They assume low volume means low risk. It's the opposite. Low volume removes shock absorbers. In a liquid market, big orders get absorbed. And in a liquid market, even small orders cause violent moves. That's why silver didn't grind higher. It jumped. That's why prices gapped instead of consolidating. That's why $79 didn't act like resistance. It acted like paper. Now layer that on top of what's already happening physically. Shanghai is clearing silver at $85. China's export controls begin January 1st. Industrial buyers are racing to secure supply before contracts reset. Dealers are pulling inventory because replacement cost is unknown. So while paper markets are thin, physical markets are closing. That combination is explosive. Think about it from a dealer's perspective. If you sell silver at $79 today, but you know Shanghai is paying $85, and you know supply tightens next week, why would you sell? You wouldn't. You freeze inventory. That's exactly what we're seeing. Call for pricing. Out of stock. Temporarily unavailable. Not because demand vanished, because risk did. This is how shortages actually begin. Not with panic buying, but with sellers stepping aside. Now look at the banks. They're trapped in the middle. They are short paper silver. They rely on rolling contracts. They rely on liquidity. But during Ghost Week, liquidity disappears. That's when margin calls hurt the most. That's when forced buying happens. That's when one liquidation can move the entire market. And that's what these sudden spikes are telling us. This was not coordinated buying. This was forced behavior. Somebody ran out of margin. Somebody failed a risk threshold. Somebody hit the button that says, close everything. Now, when clearinghouses take control of a bankrupt position, they don't negotiate. They don't care about price. They care about survival. And when that happens during an illiquid window, price discovery doesn't negotiate either. It teleports. This is why silver jumped multiple dollars in straight lines. Not because the world suddenly woke up, but because the system blinked. And when systems blink during illiquid windows, they reveal weakness instantly. Here's what makes this even more dangerous. When markets reopen fully in January, the damage doesn't reset. It compounds. January brings fresh capital, pension rebalancing, institutional inflows, funds chasing performance, and they won't be buying into a calm market. They'll be buying into a market that already fractured. That's when gaps widen. That's when limit up days appear. That's when volatility becomes structural. Ghost Week doesn't create problems. It exposes them. And right now, silver is exposing stress across the entire financial stack, from bullion dealers to banks to clearing houses. Up until this point, everything we've talked about has been pressure. Tight supply, broken arbitrage, illiquid timing, rising physical demand, but pressure alone doesn't break systems. Liquidation does, and this is where silver becomes dangerous. Because silver is not just another commodity, it sits inside the balance sheets of banks. For decades, large bullion banks have played the same game. They sell silver forward, they short futures, they write options, they hedge dynamically. As long as price stays calm, as long as contracts roll, as long as nobody demands delivery at scale, the system works. But that system is built on one assumption. Price will not move violently while liquidity is thin. That assumption just failed. When silver moved more than 10% in a single session, that wasn't momentum. That was a liquidation signature. Emergency liquidity requests. Clearing members under pressure. You don't hear this on the news immediately because talking about it creates panic. But the signals leak out. Repo injections. Sudden balance sheet expansion. Quiet central bank support. That $17 billion liquidity injection didn't happen randomly. It happened because something broke somewhere. Silver is small compared to bond markets or equities, but it is high beta. Small moves create large damage. And when banks are short something with limited physical supply, they are exposed in a way no algorithm can hedge. Here's the uncomfortable truth. Banks don't need to fail publicly for the system to crack. They just need to lose control. Control over pricing. Control over rolling positions. Control over confidence. Once confidence fades, paper contracts lose authority. And silver is uniquely positioned to expose this. Because unlike equities, unlike bonds, unlike derivatives, silver must be delivered. It is consumed. It disappears. You can't print it. You can't roll it forever. And when banks realize they are short something that industry refuses to release, the game changes. That's when you see dealers pulling inventory, wholesalers refusing quotes, exchanges widening margins, trading halts. Limit up days, these are not signs of health. They are signs of stress containment. This doesn't mean the system collapses tomorrow, but it does mean the rules have changed. Paper markets are no longer in charge. They are reacting. And when reactive systems meet physical constraints, price does not return to equilibrium quickly. It resets. This is why silver doesn't top cleanly. It overshoots. It corrects violently. Then it moves again. Because the system is no longer balancing supply and demand. It is balancing damage. In normal trading, buyers and sellers negotiate. In liquidation, negotiation ends. The clearinghouse takes over a bankrupt position and issues one instruction. That order consumes the entire order book. That's why price doesn't climb smoothly. It jumps. Straight lines, no pullbacks, no resistance. That's not excitement. That's forced buying. Now here's where it gets systemic. For every winner in that move, there is a loser, and the losers are not retail traders. They are large institutions with short exposure. When a bank is short silver and price explodes upward, their margin requirement increases instantly. If they cannot post collateral fast enough, their position is liquidated. And once one large short is forced to cover, price rises further, which triggers margin calls on the next short. This is how squeezes cascade, not because everyone buys at once, but because nobody can exit without buying. This is why rumors of bank stress start circulating. Missed margin calls. Up to now, everything we've discussed could still be dismissed by skeptics as financial stress. Short squeezes, liquidity issues, bank exposure, paper market mechanics, but this is where that argument collapses. Because silver is not just a financial asset, it is infrastructure. And once industrial demand steps in aggressively, financial markets stop being the driver. They become the follower. Let's start with one simple fact. Silver is the most electrically conductive metal on Earth. Not almost the best, not one of the best. The best. There is no substitute that performs at the same level in high efficiency systems. That's why silver sits at the center of modern technology. Solar panels, electric vehicles, battery management systems, power electronics, high density data centers, AI hardware. These systems don't care about price charts. They care about availability. And this is where the situation becomes dangerous for paper markets. When an investor can't buy silver, they wait. When a factory can't buy silver, production stops. And stopping production costs far more than paying a higher price for metal. That's why industrial demand is described as inelastic. It does not respond to price. It responds to necessity. This is why Elon Musk's comment mattered. Not because he's famous, but because he runs companies that consume enormous quantities of silver. EVs use significantly more silver than combustion vehicles. Solar panels use silver paste in every cell. New high-efficiency panel designs use more silver, not less. And AI data centers push conductivity requirements even further. So when industrial leaders express concern about silver availability, they are not speculating. They are warning about supply risk. Now, layer this on top of China's position. China does not just manufacture the majority of the world's solar panels. It controls refining. It controls processing. It controls throughput. And starting January 1st, export flow is no longer automatic. Licensing replaces free movement. Priority shifts inward. This means something critical. Western industry is no longer competing only with investors for silver. It is competing with China's domestic industrial base. That changes everything, because financial markets can pause. Factories cannot. When Shanghai pays $85, it is not bidding against traders. It is bidding to keep production lines alive. And once that behavior spreads globally, paper prices lose relevance. COMEX can print 79, 75, 70. It doesn't matter if metal isn't offered at those prices. This is how paper markets die. Not with a crash, but with irrelevance. And this is why arbitrage has stopped. In theory, traders should buy silver cheap in the West and sell it high in Shanghai. In reality, they can't, because metal is not freely available. Export restrictions block flow. Logistics are constrained. The replacement cost is unknown. That turns arbitrage from a risk-free trade into a career-ending risk. So nobody takes it. And when arbitrage stops, markets stop communicating. That's when regional pricing appears. That's when two prices exist. That's when systems fracture. This is the point of no return. Because once industrial buyers begin locking in supply directly, they bypass financial markets entirely. Long-term contracts. Direct refinery relationships. Strategic stockpiling. Silver leaves the market ecosystem. And when that happens, paper contracts represent something that no longer exists. This is why physical shortages don't resolve quickly. They compound, because every ounce removed today is an ounce that cannot be traded tomorrow. This is the point where most people get shaken out. Not because they were wrong, but because they misunderstood what comes next. When silver first breaks free from paper control, it does not move smoothly. It does not trend politely. It becomes violent. Sharp spikes, sudden drops, fake calm, then another surge. And for anyone who hasn't lived through a real commodity repricing, this behavior feels like danger. But for professionals, it means the opposite. It means the market is finding a new equilibrium. Here's the mistake most people make. They think volatility means uncertainty. In reality, volatility appears when certainty collapses. When a system no longer agrees on price, movement becomes chaotic. That's not weakness. That's transition. Stable systems don't behave like this. Stable systems don't gap between regions. Stable systems don't freeze dealers. Stable systems don't produce two prices for one asset. Those are signs of stress release. And stress release is never linear. Now let's talk about the pullbacks, because they are guaranteed. At some point, silver will drop sharply. $5, $10, maybe more, quickly. And when that happens, headlines will scream, silver crash, bubble burst, game over. This is where most people make the worst decision of the cycle. They sell into liquidity traps. Here's what's actually happening during those drops. Banks push price lower to trigger stop losses. Algorithms force liquidations. Weak hands exit, but strong hands absorb supply. The structure underneath does not change. Shanghai does not suddenly get cheaper metal. Factories do not stop needing silver. Export controls do not disappear. Inventory does not magically refill. The drop is psychological, not structural, and that's the difference that matters. This is why experienced commodity traders do not ask, is price going down? They ask, is availability improving? And right now, availability is getting worse. Volatility does not mean the system is fixing itself. It means it is failing loudly. This is why the most violent moves often happen after the breakout. Because once price escapes suppression, control mechanisms stop working. Options hedging becomes unstable. Margin requirements spike. Risk desks pull back. That creates feedback loops. And feedback loops create exaggerated moves in both directions. But here's the key insight. Paper volatility does not increase metal supply. No amount of chart movement creates new ounces. So while screens shake people out emotionally, the physical market tightens quietly. This is why dealers pull inventory before price spikes. This is why premiums rise during pullbacks. This is why Shanghai doesn't flinch. And this is why most people exit right before the most powerful phase. They mistake discomfort for danger. Now add timing to this. We are approaching January. That matters more than most realize. January resets capital flows. Pension funds rebalance. Institutions deploy fresh money. Performance chasers enter. Silver was one of the strongest assets of the year. That attracts attention, and attention brings capital into a very small market. Silver is tiny compared to equities or bonds. It does not take much institutional flow to overwhelm it, which means volatility will increase, not decrease. This is why trying to trade every move becomes dangerous. Because this phase rewards positioning, not prediction. It rewards patience, not precision, and it punishes emotional reactions. Years from now, when people look back at this period, they won't remember the exact price. They won't remember whether silver was 79, 85, or 100. They will remember the moment the system stopped agreeing with itself. Because that's what always marks the turning point. Not crashes, not headlines, not panic, but divergence. Two prices for the same asset. Two realities coexisting at once. One based on assumption, one based on availability. That is how financial regimes change. Quietly at first, almost invisibly, then all at once. Silver is not special because it's shiny. Silver is special because it cannot lie. It must be delivered. It must be refined. It must be consumed. And when those physical constraints collide with financial promises, something has to give. For decades, paper systems worked because confidence held. Confidence that settlement could always be rolled. Confidence that delivery could always be delayed. Confidence that price could always be managed. That confidence is thinning now, not collapsing, not exploding. Thinning. And thinning confidence changes behavior long before it changes headlines. Dealers step back. Buyers step forward. Arbitrage slows. Premiums rise. Inventory tightens. That's how systems signal stress before they admit it. This is why calling this a crash misses the point. A real market failure doesn't look like numbers going down. It looks like numbers that stop meaning what you think they mean. Screens keep updating. Quotes keep printing. But access disappears. Two prices emerge. One you can see. One you can transact at. That is the line silver is approaching. Not because of hype. Not because of speculation. But because structure has shifted. China controls refining. Industry controls demand. Supply cannot respond quickly. Paper leverage remains massive. Those facts do not resolve themselves quietly. They resolve through repricing. Sometimes slow, sometimes violent, but always unavoidable. This does not mean silver goes straight up. There will be volatility. There will be shakeouts. There will be moments designed to test conviction. That is how transitions work. But the direction of pressure is no longer theoretical. It is structural. And this is the real lesson. This moment is not about getting rich. It is about understanding where control is moving. Paper systems are still powerful. They are still large. They are still influential. But they are no longer unchallenged. Physical reality is asserting itself again. Not dramatically. Not loudly. Relentlessly. Silver is simply the first place the stress became visible. More will follow. And those who understand this won't panic. They won't chase. They won't gamble. They will position quietly, patiently, intelligently. Because history doesn't reward emotion. It rewards preparation. So if there's one thing to take away from this entire story, it's this. This was never about silver going up or down. It was about the system revealing itself. And once you've seen that, you can't unsee it. If this helped you see the bigger picture, if it gave you clarity instead of noise, make sure you stay connected. Subscribe.